Thanks, Rick. I appreciate Capstone in principle putting this event together, and I also appreciate the folks who've showed up to watch and listen. The issue of the valuation of solar projects is kind of interesting, especially to a developer-type audience, because if you're building the thing, you know what the costs are. You know, if you were building a factory or buying a car or a machine tool, you wouldn't need an appraiser to figure out what it was worth. Why do you need to know? What benefits does a third-party valuation have in this space? Essentially, it would be for two primary purposes. There may be third-party financing sources who would like some independent verification of asset value and cash flows. And to the extent that you are, rather than building but buying an existing solar facility, you are probably less concerned with what it costs to build, but how much money you can make operating it, and essentially how much you can afford to pay for the set of cash flows you expect it to generate, given the type of return on investment you are looking to make. Going back to the financing parties, you know, I assume a lot of these transactions are financed with 1603 cash grants for 30% and, say, project finance debt from either banks or bond issues for the remainder. The Department of Energy for 1603 needs to know what the basis is to take the 30% credit on, whether it's for an investment tax credit or a cash grant. And as such, needs to know either, you know, what is the purchase price from the contractor who built it, or for a self-contracted asset, what was the actual hard cost out of pocket to build the thing. You know, they do not have a developer's profit in there if you built it yourself, but they need essentially a cost certification or, you know, audited collection of all your out-of-pockets, including not only the hard costs for, you know, materials and installation labor, but the important thing to recall is don't leave out soft costs, which include design, engineering, consultants' fees, and even allocated salaries. You don't want to shortchange yourself there. The only thing that's really not included is any real estate, you know, a land, bricks, or mortar type costs for the purposes of taking the 30% credit. Lenders of the bank and bond buyer variety may or may not get a third-party appraisal, but you can be assured that they will be running similar sorts of cash flow analyses to make sure that the project does, in fact, pay back their principal and interest, and hopefully the numbers we'll get into a little later will show the type of analysis that they're going to be doing, although somewhat more simplified than what they will actually be doing. For either sale, leaseback, or tax equity financing, because they both are focused heavily on tax benefits, they have to, both of those types of transactions take into account the IRS definition of fair market value, which is what a lessor would have to purchase an asset to be leased back to the operator at, and it would be the basis for the majority investment that a tax equity investor makes to buy essentially the tax benefits, although not necessarily the operating profits of a solar facility going forward. The mechanics of the financings are, you know, a whole different series of webinars in themselves, and certainly beyond the scope of what we're attempting to cover here in 20 minutes. What I will try to do is look over concepts first and then get into some numbers in the latter part of the presentation. Now, when you ask an appraiser what is an asset worth, you're going to get, regrettably, an answer like, it depends. Why do we say that? What does it depend on? It depends on the way in which the value is gotten from that particular asset. There's a spectrum or a continuum, if you will, projected here in sort of low to high value. If you just scrap the thing, the value is pretty obvious. It's your pounds of aluminum, pounds of silicon, pounds of copper, pounds of steel, times the cost per pound that a scrap guy is willing to pay. If you put it under the hammer, you get auction or forced liquidation value in whatever potential buyers, who are obviously looking for a deal that you can get for a one-day auction. That is at least better than scrap value. That's the best you can say about it. If you have more time, say weeks or months, to do an orderly liquidation sale, you will get a higher number, but presumably you will not have had enough time to clear all the potential buyers from the market and have them compete with each other. If you have an appropriate marketing period, then you can get a fair market value, but even within that premise of value, there are different gradations. If you're selling components, for example, typically boxed and crated and ready to ship, you would be looking at a fair market value in exchange premise of value. If you're looking at all the assets in place, you get the value of the installation cost incorporated, fair market value in place or installed, hopefully is one that gets you your money back. The highest and best use is fair market value in continued use. In the case of a solar PV system, you're actually generating and selling electrons, and what we're talking about is a business valuation, not just an asset valuation. That's the highest and best use. Specifically with regard to some definitions, fair market value, and this is for the American Society of Appraisers, fair market value is the estimated amount at which the appraised property might be expected to exchange between a willing buyer and a willing seller, neither being under compulsion, each having reasonable knowledge of all relevant facts. So we're talking arm's length, independent, with unrelated third parties. Continuing with the definition, when fair market value is established on the premise of continued use, it is assumed that the buyer and seller would be contemplating retention of the property at its present location for continuation as part of the current operations, i.e. a sale of the business. An estimate of fair market value arrived at on the premise of continued use does not represent the amount that might be realized from a piecemeal disposition in the open market, i.e. in exchange value, or from an alternative use of the property. That is to say, the best use of a solar PV system is to generate electricity. Okay, now approaches to value. In coming up with fair market values, appraisers have to consider three different approaches to value: the cost, income, and market approach. The cost approach looks to analyze what would it cost to replace the subject asset using current technology at the time of the appraisal with something of the equivalent worth or with equivalent capabilities. You look at the replacement cost new for whatever is the current technology doing what your asset does, and to the extent it is not a new asset, you factor in depreciation. Depreciation has a number of components: physical, functional, and economic obsolescence. Physical obsolescence is actual physical wear and tear. That is reflected in solar PV by the concept of degradation, which we will see, in our numerical example. Functional obsolescence is the extent to which technology is starting to advance beyond your particular asset. If you have the next generation panels with higher solar efficiencies, your particular facility will be dinged a little bit for some functional obsolescence. And finally, if there is economic obsolescence, which is the extent to which the market has changed around you. You may have a perfectly maintained and well-operating solar PV operation, but if they have changed the laws, if everybody has gone to hydrogen fuel cells, you may lose value as a result of economic obsolescence. So those are the types of depreciation that are subtracted from replacement cost to come up with the cost approach number. The income approach, which we'll talk about in more detail, is simply the net present value of the projected after-tax cash flows to be generated by the asset, or the business, and they could be one and the same, essentially, to be appraised. And we'll show the spreadsheet at the end. The market approach is the value of an asset based on comparable market transactions for like assets. Seems pretty straightforward, however, is not always immediately applicable. Now, what do you do with the results of these approaches to value? You must consider all of them as an appraiser. Otherwise, what you have is a limited appraisal. But they're not always going to be applicable. Some assets just don't generate income. Doesn't make much sense to run, cash flow analysis on them if they don't generate income. There are some genuinely unique assets in the market. No point doing a market approach on that. Not everything really lends itself to a replacement cost approach. If you were to try to appraise a Gothic cathedral or an Egyptian pyramid, where would you start, basically? So on any given appraisal, you will have either one or two or three usable approaches to value. In looking at them, you must consider all facts and circumstances surrounding the asset to be appraised, including obviously its age, operating history, including condition, and any contracts. To the extent that you have more than one usable approach to value, you have to reconcile these two, two or three, which basically means taking a weighted average of the numbers you come up with. In order to do this reconciliation, you have to come up with the reason for weighting and be able to substantiate it. In general, the market value rules if there are comparable transactions. You can't fight the tape. The best example of that is the stock market. However, we find in industrial facilities, including generation facilities like solar PV, you can't necessarily find directly comparable transactions. So we tend to use cost and income primarily, and weighting of cost and income is a function of where do you have more confidence in your numbers. If you're building a widget factory for an unproven market with unproven technology, you may feel more comfortable that that factory is worth the cost to construct it as opposed to whatever financial projections were made. If you have a power plant with a Tennessee Valley Authority fixed price offtake for 30 years for 100% of your output, you have a pretty good case for using the entire income approach. Also, the income approach will always provide a maximum value even if the cost number comes out higher, because no economic investor is going to pay more for an asset than he can get his target return on investment out of. And if markets have moved, if you're looking to buy a hotel in a soft real estate market, it may well be selling for less than replacement cost for that reason. The other thing to consider when you're especially looking at an income approach, and we'll be looking at a 20-year example, is the residual value. In the case of solar PV, what you were looking at is if you have a 20-year deal, because it's a 20-year PPA, but you have the technology to potentially generate for another 5 or 10, you can project the type of PPA you could sign up from years 10 through 20. You can continue to run, your projections for another 10 years and take the present value as of year 20 for the cash flows from year 21 to 30, and that will be your residual if you can use it in the same location. If you can't use that location and you have to move it, you have to subtract deinstall, transport, and reinstallation costs. And quite frankly, for a 20-year-old asset, those are generally going to be higher in the PV space than the value of the residual, so it essentially wipes it out if you can't stay on that ground or on that roof. Okay, I apologize for not having advanced the slide. Okay, now we're about to go into the cash flow model from an actual proposed transaction we had seen. This was a New Jersey transaction, so you'll see fairly high SRECs in it. It was a 1.25 megawatt plant with a capital cost of about $6.4 million. Solar power production, that's about a little over 5 million a megawatt. Solar power production projected of 1,482,000 kilowatt hours per year. A degradation factor of 0.5% a year. Initial PPA pricing of 12 cents a kilowatt hour, escalated through 20 years. SRECs of almost 4 times as much, 47.5 cents per kilowatt hour. They did not inflate, and we're only assuming 10 years of SRECs here. Operating expenses, including, O&M costs, insurance and monitoring of a little over $50,000. Inflation of both costs and revenues, except for SRECs, of 3%. A 30% grant. Depreciation on a 5-year maker's basis equal to 85% of the actual qualifying cost of the asset, because of the offset of half the value of the ITC is subtracted from the allowable basis for depreciation purposes. Residual value, assuming that you can continue to generate electricity in place, of about $1.3 million at year 20, and a discount rate of 5.75%. Where does 5.75 come from? It's a weighted average cost of capital. Don't really have a blackboard to go through this, but you have, assuming typical utility kind of balance sheet, 52-48% leverage, BBB 20-year bonds at 5.5%, which after-tax equivalent is 3.3%. Cost of equity roughly 8.3%, which you build up times starting with an with a risk-free rate, i.e. 20-year treasuries of 3.8%, and a common stock premium per that formula as shown. That gets into more financial theory than we really have time to go into here, but the slides will be available and you can at least work the math. The one thing that you can't ignore actually is the unsystematic risk premium, which is considered but is not applied for every company and is a zero that happens to be here. The math works out to about 5.7. It was rounded to 5.75. Okay, so we have the spreadsheet. This is actually the first 8%, the first 8 years of a 20-year spreadsheet, because it was impossible to read, but you can see the patterns, and it basically, each of these numbers go out for the next 20 years, with the exception of the SRECs, which only go out for 10, and the energy tax credit only happens in year 1, and the residual only happens in year 20. So our power sales start out basically the kilowatt hours times 11 cents, times 12 cents rather, degraded at 0.5% a year, but inflated at 3% a year. Our SRECs are that 47.5 cents per kilowatt hour sold with the degradation factor. They only go out to year 10. Our total revenues are the first 2 lines added up. From year 11, they're power sales only. Operating expenses is the $52,000 number, which also gets increased over time. Subtract all that, you get net operating or pre-tax income, from which is subtracted depreciation expense, which is a non-cash expense. In the first couple of years, this actually gives you negative taxable income and negative actual cash taxes. We have assumed, for the sake of argument, that for this pricing model, the owner has other income and can use those negative taxes as a benefit to against his other taxable income. That is useful for present value purposes if you are using, if you are carrying forward your losses until this specific project can actually utilize them. That gives you a lesser present value, but we reflect that in the sensitivity analysis. I know it's a little again, without a blackboard, a little hard to follow. Okay, so we add back depreciation, and we get our after-tax cash flow. In a more complex model, you would also add CapEx and, maintenance reserves and debt service to that figure. But that's not the purpose of a pure valuation analysis, which is generally done on an unlevered basis. We have our present value factor, assuming the 5.75, so that's that number. First number is 1 over 1.0575. The second number is 1 over 1.0575 squared, and so on and so on. You multiply the present value factor times the actual after-tax cash flow, and you get the PV of each of those after-tax cash flows. Here was where the residual was plugged in at year 20 and after-taxed as well. Our ITC, we assume, comes in at the beginning of the year and is not subject to a year of discounting. Therefore, our complete, this is the line which has our cash flows on a PV basis, and they all add up to about $8.4 million. Okay. What happens if we have a number of different changes, residuals, change in PPA rate, change in SREC rates, different discount rates, different types of depreciation, NOL carry forward? Well, I'm glad you asked, and this is the last slide, so we hopefully won't go too far over. Here's our base case, $8.4 million. If, in fact, we can no longer use our original site and we have to move our assets, it wipes the residual out. Therefore, our cost, our NPV is hit by about $400,000 or about 5%. What happens, and you don't expect to get a unilaterally changed PPA, but just as a sensitivity, what if you go from 12 cents to 11 cents before inflation on a PPA rate? That's a hit of about 2%. Now, an SREC, this is something you have to worry about. I think, what if you had a 5-year contract and you were assuming that you continued to get the same rate of SREC in year 6 through 10, but you were wrong and it was reduced by 50% in those years? That was a relatively large hit, 8%. What if the whole project just became much riskier, because instead of selling to utility, you were selling to an industrial user who was, say, junk credit grade, or because you did not have a locked-in SREC contract and you were speculating in that market, which made life a little riskier. Let's assume a 10% WACC rate. That is a big hit, 15% hit. Here's actually some good news. Let's say you finish your project in 2011. You get bonus depreciation, and you can use all the tax benefits of all your depreciation basically expensed in the first year. That's a 2% benefit. Now, what if, unfortunately, you do not have a deep pocket parent and the only tax return you're dealing with is the one of this project completely, and you carry forward your tax losses and benefits that you can't lose until they offset income in later years? As it turns out, that's not that big a hit, about 1%. So those are some of the obvious sensitivities to look into, and that is all we had of the prepared presentation. I know we covered a lot of ground, but I'm open for questions.
Thank you very much, Ken, and very technical conversation. If you could go ahead and proceed to the next slide, just let everybody see a picture of your face. Let you know that we're now open for questions, and there have been quite a few that have come in. Since we just have 3 minutes left in the official time, I just wanted to let everybody know that this presentation has been recorded and it will be posted online. You'll receive an email in about an hour later on today about that. Also, Ken Kramer has agreed to make this presentation available as a PDF, so I will also post that. And before I start the questions, I want to thank again our sponsor, Principal Solar, who is in the business of buying and operating existing solar power assets at principalsolar.com. That way, now that I've gotten that out of the way, I'm going to go ahead and field all of these questions, but for people that need to drop off at 30 minutes, feel free to do that, and you'll be able to see these questions on the recording later on. Okay, so the first question that came in, Ken, was from John. He actually had a question about 3 different types of solar players other than the power generation equipment. He wanted to know about how you would value equipment manufacturers like GT Solar, 2 is panel manufacturers, 3 is installers such as Principal Solar, for example. So how would your analysis change for those types of players?
Okay, well, this is generally looking at a business, this analysis is generally looking at a business that comprises a single revenue generating facility. So I would feel more comfortable talking about a chip factory, a panel factory, or an inverter factory, which I think is the best analogy. A PV system is essentially an electron factory. It has capital costs up front. It has operating costs and revenues going forward. And the basic layout of the of the spreadsheet, of the cash flow analysis, would be the same. For a business valuation, especially for a publicly traded company, that is more complex. That would, look more at stock market comparables, current M&A transactions, and a number of variables that are beyond the, the scope of this type of analysis. But I would say for the model of a factory, I would look at least the first 2 of the 3 examples mentioned in a very similar way, at least conceptually.
Okay, great. Next question was from Michael, and he asks, how expensive is an appraisal like what you discussed here? Who typically pays the fee in the photovoltaic solar industry? Is it based on a percentage, et cetera? And how often do you need a new appraisal?
Okay, well, appraisals generally go with financing or investment. So generally, depending on the nature of your financing, upfront would be the most logical time to get one. This is going to vary with size, level of detail, type of user. I'd, be happy to talk about costs on a case-by-case basis. It's somewhat difficult to generalize. With regard to, appraisal firms generally price on a, legal model in terms of what is a man-hour or a man-day cost, but we will essentially use that unit of time to generate a scope of work to provide a fixed fee. It is actually against the, the code of ethics of the American Society of Appraisers to take a contingent fee, i.e. a percentage of the appraised value, because that you can see that there's the possibility for conflict of interest there.
Yep, that makes sense. And the follow-up question from Ken related is typically what size of systems, or I guess what would be the minimum size of a solar system that needs to have an appraisal in kilowatts or dollars?
Well, I don't know if residential appraisals, residential systems typically would involve them. We're involved in the industrial market. We are generally operating at a minimum in the hundreds of kilowatts, to over a megawatt space. And it really is a function of the extent to which somebody is either a third party financing one of these assets, needs it, or a somebody who is buying an asset that is already in place, wants a third party to say, what can I actually make on these things? For example, in dealing with a project finance lender, they're frequently not going to get a third-party appraisal. They'll do this type of analysis, as I mentioned earlier, themselves.
Okay, thank you. One other question from Scott. Read this morning about the Bonneville Power Authority in the state of Washington. They issued a new set of rules that governed when they would buy hydropower preferentially over wind power. This rewrote the contracts and revenue estimations that many wind generators were relying on. So as applies to solar, given that you have an asset with a 2-decade or more lifespan, how do you account for something of this nature in your valuations of the asset?
Well, my best understanding of contract law, and I'm not a lawyer, is that one party doesn't get to unilaterally change the contract. So, I foresee a legal windfall. But but I think the bigger issue is the fact that, I guess to use the family show version of this expression, stuff happens. And if Bonneville is successful in, after presumed litigation or heavy negotiation, reducing the income that it pays to wind and power providers who thought they had binding PPAs, I think this is going to show that the industry is perhaps a riskier place than it looked. And the way that is customarily reflected, because you can't, I don't think anybody could have predicted what Bonneville was going to do. All you know is stuff does happen that you can't predict, and possibly if you have to reflect the fact that the world is a riskier place, you're going to have a higher discount rate. And I think that's probably how the market will shake up. How many letter grades of bond rating that, and how many basis points or percentage points of discount rate increment that translates to remains to be seen. But I think that is the way that I would think the market would react to the arguable reduction in potential value of these assets as a result of unilateral surprises like this one.
All right, thank you for that. And I'll give one more question again from another Ken. And actually, I think you might have this on your one of your previous slides. It was, what impact on valuation does the risk of losing the SREC income carry? Because this market is unstable and it relies on local politics. And I couldn't remember, but I think you might have had the loss of SREC income included.
Yes,
and
I mean,
in particular, if I remember, yeah, this was for New Jersey, which is probably the most stable SREC market. But the example would be what happened in Pennsylvania, where people were counting on $150 or more, and the price is almost zero now.
Well, that is, it's interesting because the reason in this example, you had, there are contracted SRECs, there are, people who want to, sort of go naked and do it spot. It's, the project finance world likes to see, a long-term fixed rate PPA equivalent. You can, let's say you believe that 3 years you can predict, or 5 years you can get a contract. Well, that is, probably, if that's as far as your headlights go, then you probably want to do a sensitivity analysis, like the one we did here, which just said, okay, you've got pretty good visibility for arguably, a contract for 5 years, but let's just say you were assuming life would continue to chug along for the next 5 years, and you were wrong. Well, in this case, you took an 8% hit. I'm guessing it's probably linear, and if the market just completely fell off a cliff after year 5, then it'd be a 15% hit. So it's a big unknown, and I think that you have to think long and hard about reflecting this both in your revenue line and in your discount rate. And if there's a magic formula for quantifying it, I'm not really sure what that might be.
The magic formula to predict the future that we are all looking for.
Right.
Okay, that was the last question. If there are any, if you could go back to the last slide again that had your name and email. If there are any additional questions, feel free to send an email to Ken directly. And our thanks again to Principal Solar as the sponsor, and to Ken Kramer and Rushton Atlantic. And that ends today's webinar. Thank you very much.
Thank you all.